the mistake they're making is they looked at that 2009 to 2020 period of QE, negative rates in Europe, negative rates in Japan, and they've convinced themselves to anchor off that. That was normal. And now they're looking at rates today and they're saying, boy, they're way higher than that 29 to 2020 period. They're bone crushingly high. They're going to hurt everything. That was the QE period. We're in the QT period. We're going to go to the normalization period. Actually, 2.5 on real rates or term premiums turning positive and all these other things that we talk about. Term premiums being the extra compensation that you get for owning longer term securities. These are all more, to my mind, returning to a pre-QE era level, not that they're abnormally high. And that's where I think that most people are going to be struck or surprised by what interest rates, not only are they surprised by what interest rates have done, but I think they're going to be surprised what they're going to continue to do.
On this episode of What the Finance podcast, I have the pleasure of welcoming on Jim Bianco, who's the president and macro strategist at Bianco Research. So, Jim, thanks so much for coming on the podcast today.
Yeah, thanks for having me.
No problem. I'm looking forward to the conversation because, lots happening in the market. So, I guess from your perspective, what are you currently watching?
Oh, I think right now, watching, and, we're recording on October 19th, 35th anniversary of the stock market crash, is Jay Powell and monetary policy. He spoke today at the New York Economics Club, and in Q&A, he kind of made it known that the Fed is either done raising rates or about to be done raising rates. Maybe there's one more rate hike, and then he started saying stuff about long and variable lags, and the market took that as dovish. And I think what's most important about that is short-term interest rates, which are tied to Fed policy, fell on that news. But long-term interest rates rose quite a bit. We made a new 14-year intraday high on the 30-year. We made a new 17-year intraday high on the 10-year. We got the 499 on the 10-year briefly. Thought maybe we'd see that 5%, but we just came up a little short of it for now. And I think really what that shows is where is the market's thinking? If the Fed is not going to continue to raise rates, if it's not going to continue to fight against inflation, and Jay Powell said he was open to the idea that the Fed, A, was not tight. He said that. They may not be tight. And B, he said that we might be running higher than normal inflation. Well, if you're not going to raise rates, I can see why the short-term rates are going to go down, but I can also see why the long-term bond market, long-term rates, or duration, as we call it, is going to sell off and you're going to have higher yields. And the stock market has been kind of following the bond market around quite a bit. So I think he's setting up a policy mistake. I think he's setting up a big time policy mistake. He also said, rising rates are going to do the work for the Fed. Look, you're in London. You can remember a year ago when Liz Truss offered up her budget and the bond market didn't like her budget. Well, the bond market did the work of the politicians. It wanted the budget to be it did not want that budget. How'd that go? It destroyed the bond market. It caused havoc in your economy. And Liz Truss didn't last longer than a head of lettuce. So be very careful when you want the bond market to do your work. Oh, you want the bond market to slow the economy? It'll slow the economy. You won't like it. You won't like how it's going to do it and what rate it's going to go to. But if you're going to leave it to the bond market, that's what you risk. Ask Liz Truss.
Yeah, it's interesting when you actually look at it. I think yields are higher in the UK now than they were during Liz Truss time. It's like, I guess the challenge is always like the speed of how it occurs, and that's what we've seen. It's sort of been a bit slower.
You've got 300 years of data from the Bank of England. And nowhere in that data does it show that long gilts went up 100 basis points in like one day. And that's essentially what they did last September. And yes, and once you set up once you broke the market and you set up the trend towards lower prices or higher yields, yeah, you're right. Those yields kept going higher. And that's what I'm really afraid of now. If you think, you being the Federal Reserve, if you think that the bond market's going to do your work, it isn't going to go from 499 to 504. It's going to go to some unimaginable level, and it's going to slow the economy. It's going to wreak havoc on the economy. That's my fear. I'm not predicting that, but that's my fear. You want the bond market to slow the economy, it will do it, and you won't like it. That's the game that they're playing, and that's what I'm very worried about right now.
So, can you just explain why a pivot, or I guess talking about a pivot, would actually increase yields on the long ends?
It comes back to inflation. And I am of the opinion, let me back up and give you my big picture. I'm of the opinion that the biggest economic event of our lifetime was the shutdown restart of the economy in 2020, COVID inspired. It was bigger than the financial crisis of 08. It was bigger than the 87 crash. You know, none of us are old enough to remember the Great Depression. So that's why I said of our lifetime. I didn't say ever. And what happened was we rebooted the economy. Coming out of that, the economy was not the same. Now, the same does not mean dystopian or worse. It's different. The biggest difference that we're all aware of is remote work. The labor market is fundamentally different than what it was in 2019. Goods preferences, let me stick with the labor market again. If it is fundamentally different, and all of the surveys are correct, and anecdotally they seem to be correct too, that most people go to the office 3 days a week. So that means that pre-pandemic, you were home 2 days a week, Saturday and Sunday. Post-pandemic, you're home 4 days a week, Saturday, Sunday, probably Monday and Friday, or some variation in there. You doubled the time you're at home. You know what that means? That means your lifestyle has changed. Your consumption basket has changed. Lots of things about what you do with your life today is not what you did 4 years ago, because you're home more right now. And we're talking about somewhere in the course of about 50% of the workforce. So therefore, supply chains need to adapt to this. Retailers need to figure out what they should be selling. Manufacturers should be figuring out what they need to be making. Home builders need to figure out the types of homes and where they need to be building them. And not enough people are doing that. Not enough people. And what they're doing is they're saying, nah, this is a temporary thing. They're all going to come back to the office. Yeah, what do people want to buy? Whatever they wanted to buy in 2019, that's what they want to buy. What house do they want? The same house they wanted in 2019, in the same location that they would have bought it in 2019. And so by this fighting of this idea that there's been this big change, and I haven't even touched on deglobalization, using energy as a weapon like the Saudis and the Russians are with OPEC Plus, or the Russians are with LNG to Europe. I think that what we're finding is that there's more frictions in the economy, and the economy's out of balance, and therefore we're having more inflation. Now, can it get back into balance? Yes. It needs people to recognize it's out of balance. We have to fix it. The analogy I've used is the U.S. after the Second World War. September 45, Japan surrendered. October 45, the payroll report showed 2 million jobs were lost for that month. And on a percentage basis, it was almost as big as 2020 when we lost 14 million jobs in a month. In October 45, when we lost 2 million jobs in a month, there was no mailing of checks. There was no emergency action by the Federal Reserve. There was no version of a CARES Act. It was celebrated because those were jobs making the instruments of war, tanks, fighter planes, guns. We didn't need them. The war ended. Everybody knew in October 45, when those 2 million jobs were reduced, that it was A, good thing, and B, we need to go about figuring out what the new economy is going to look like. And we had some fits and starts in the 40s. We had a recession in 46, 47. We had another one in 49. We had a bout of inflation in 47, 48. And then we had a secondary echo of it. But then within 5 or 6 years, we kind of got everything reoriented, and we had a boom into the 50s and 60s. Today, we panic. We want everything to go back to the way it was in 2019. We mail people money. We talk about return to normalization. Jay Powell mentioned at least 5 times in his speech about these are getting back to pre-pandemic levels, because what we want is we want that to be the baseline that we want to return to. And I don't think we are returning to that baseline. But if we were to recognize that this is a different economy, we could start restructuring it. And that's a nice way of saying spend a lot of money to change a lot of things. in order to make the economy more efficient for the post-shutdown restart economy. But we're not doing that. So we're going to wind up with more inflation. Now, Jay Powell said some of that as well. So he's kind of in agreement. And because of that, I think we're going to be stuck with structurally higher interest rates. He kind of hinted at that, but he said no more on the short end of the yield curve. They'll allow it to happen on the long end. And then they wash their hands of it by saying it's all about excess supply and it's all about term premiums. All of that's driven by inflation is where I see it. I know that I hold a heterodox view from most of Wall Street on the inflationary consequences that we're having post-pandemic. And because of that, I think we need to understand that nominal GDP is going to stay higher, and maybe we're even going to have some growth in the economy too. Now, when people hear that, they say, so you're telling me there's going to be a bull market in stocks for the next several years? Because if we're going to have higher nominal growth and we're going to have higher real growth, then companies will have earnings. Well, yeah, they'll have earnings, but also they're going to have to compete with interest rates. In 2019, if you didn't like the stock market, you could put your money in a money market fund and get zero. And if you're in Europe, you could put your money in a money market fund and get negative. Well, I guess technically retail didn't get negative, but institutions did get negative interest rates. You were assessed a penalty for keeping your money in the bank. Today, if you don't like the stock market, you can put your money in a money market fund. Now, the great book by Dr. Jeremy Siegel, Stocks for the Long Run, which is a new edition, is out this year, talks about what is the long-term potential for the stock market. They come up to about 8 or 9%. This is over many years, over many cycles. You should expect the stock market to give you about an 8 or 9% return. I get 5.5% in a money market fund right now. I could get 2/3 of that long-term return in the stock market with no market risk. So this is what the stock market has to deal with. Yes, we might have stronger growth. Yes, you might have earnings. But yes, everybody's going to turn their nose at you and say, I'll take 2/3 of what you're going to offer with no market risk. Thank you very much. You're going to have to offer something more than just 8%. And if we wind up seeing rates continue to go higher, then that hurdle or that competition that stocks are going to have is going to grow even greater. So this might not be a stock bullish story, but it's not a 2019 story. A recession and no earnings, and that's why the stock market goes down. Everything's great for the stock market, but it's not good enough because there's this other competition over here that everybody's liking. And yes, the biggest inflow all year right now has been to money market funds. It should be. It's a great deal right now. 2/3 of the stock market's gain, no market risk. So that's kind of where I've been, or where the bigger picture of what I am thinking about when it comes to the economy and bonds. I think that the bear market in bonds began in August 2020, or the end of the 40-year bull market. We've begun year 4, August 23, started year 4 of the bear market. It will run several years. Yes, along the way, we'll have a 1 or 2 or 3 year bull market or cyclical decline in rates in the middle. I don't think quite yet now, but ultimately we have to be ready for higher yields as we look through the rest of the decade.
What levels do you think we'd have to get to for the Fed to sort of come in and start buying on the long end, or sort of just changing their policy? Do you see that potentially being the case?
Yeah, I think that, we're probably, what I'm fearing is if you're going to leave it to the market and long-term rates go up, the market's going to have to say, fine, all right, we have to take rates high enough to slow the economy. That is going to be very, very high. I think that's not just going to be 10 or 20 or 30 basis points higher than we are now. We're at 4.95 in the 10-year note. It's going to be much higher than that. Austin Goolsbee, who's the president of the Chicago Federal Reserve, on October 5th, was on a podcast, the Odd Lots podcast at Bloomberg, and he talked about the puzzle of interest rates. And he said the puzzle to him was, why last year, when inflation was 9%, did the 10-year note peak at 4.20? And why this year, when inflation is under 4%, is the 10-year now at nearly 5%? I think there's a very simple answer. Last year, you were raising rates at 75 basis points a meeting. and you were doing the work. So the bond market didn't. This year, you're not raising rates anymore. And you're telling the bond market to do the work for you. And that's exactly what it's doing. And like I said, what I'm really, people nod, yes, the bond market's doing the work for it. That's not 6 basis points. That's not 11 more basis points. That is a lot more that I think rates are going to go higher from here. And if you see more strength in the economy, if you see any evidence that inflation is staying sticky, and again, I think that inflation is going to stay sticky because of that imbalance in the economy, not 8-10 Zimbabwe inflation, but 3.5% inflation versus the Fed's target of 2. And yeah, that matters at the margin, especially when it comes to interest rates. So Jonathan Gray, of the head of Blackstone, was in the FT today in an interview talking about that rates are crushingly high and that they're that they're impairing deals and it's going to hurt the consumer now that we've got mortgage rates at 8%. And the implication he's giving is the implication what all bond bulls are giving. These are out of control high rates, and stay long bonds, yields will come down. I don't think they are. I think the mistake they're making is they looked at that 2009 to 2020 period of QE, negative rates in Europe, negative rates in Japan, and they've convinced themselves to anchor off that. That was normal. And now they're looking at rates today and they're saying, boy, they're way higher than that 29 to 2020 period. They're bone crushingly high. They're going to hurt everything. That was the QE period. We're in the QT period. We're going to go to the normalization period. Actually, 2.5 on real rates or term premiums turning positive and all these other things that we talk about. Term premiums being the extra compensation that you get for owning longer term securities. These are all more, to my mind, returning to a pre-QE era level, not that they're abnormally high. And that's where I think that most people are going to be struck or surprised by what interest rates, not only are they surprised by what interest rates have done, but I think they're going to be surprised what they're going to continue to do.
Yeah, it's really interesting. So you've talked about how businesses have been caught off guard and sort of hoping that things go back to normal. Investors have done this. Some investors have done the same. Would you say economists as well? Because I guess you posted a really interesting thing on Twitter recently where it was talking about how at the start of this quarter, everyone thought GDP growth was going to be 0 or even negative. And now they're, I think base case is about 3.4. So it's a massive difference. So do you just think people haven't really changed their analysis to, as you said, the current economy and what we're really seeing?
Yeah, absolutely. And I think that that was the case in point, that the consensus forecast in late June, a couple of days before the third quarter started, was this quarter would be 0. And now the consensus forecast is for 3.4, and the Atlanta Fed GDP tracker is at 5.4. Can the Atlanta Fed GDP tracker be wrong? Yeah, it's always wrong. But it's not wrong by hundreds of basis points. It might be wrong by 1%. Maybe 1.5. That's historically what it's been wrong by. It's not been wrong by 3, 4, 500 basis points. So we're looking at a very, very strong quarter, any way that you, slice it. And all the economists 3 days before the quarter started thought it would be a recessionary quarter. Now, what I said in that was, your models are wrong. You still think this is 2019. You still think this is pre-shutdown. You still think that the way the world works was that. It doesn't. And that's why it's stronger than you think. And of course, stronger means higher rates, and that's going to be competition for stocks. And you're refusing to accept it. Bloomberg, yesterday was the 1-year anniversary of the famous Bloomberg model that said that there would be a 100% chance of a recession over the next 12 months. That was 1 year ago yesterday. We've got the opposite of that. We got a boom going on. And by the way, that same Bloomberg model that a year ago said there was a 100% chance of a recession in 12 months currently still has a 100% chance of a recession in 12 months. Just stay with 100 forever, and one day it will be right, I guess is the way that they're doing it. But now I made fun of them. In all seriousness, the model is based on the way the world worked pre-shutdown. And that's what I think the flaws are. And economists are not willing to entertain. Here's how the world worked. Okay, throw that away. We have to redesign the models right now going forward. Another example for you. I also tweeted out recently, or actually earlier today. Initial claims for unemployment insurance in the United States came out at 198,000 last week. The lowest number since January, and one of the lowest numbers in the last 50 years. I mean, it was lower in January and December of last year, but then you got to go back to the early 70s to find another time that it was lower than that. What's very surprising about this was labor economists who understand the labor market said, we had a Hollywood writer strike. We've got the UAW on strike. We had the big healthcare provider, Kaiser Permanente, go on strike. They settled that strike late last week. Striking workers cannot file for unemployment insurance, but the suppliers and vendors that supply those Ford and GM plants, and maybe run the food trucks, if you will, on the Hollywood sets, that supply or vendors for Kaiser Permanente in the field of healthcare. If they wind up having to see no business and have to furlough employees, those employees can file for unemployment insurance. And the estimates were, based on the way the world worked before 2019, this should increase the unemployment claims by 100,000 jobs. Instead, they went down by 30,000 jobs. Has no one lost their job because there's widespread swaths of auto workers on strike right now? The thousands of small and large suppliers and vendors, they have not furloughed one single employee. And what we do know from history is when you get furloughed from your job, you file for unemployment insurance. Has that changed? Are people sitting at home not asking for unemployment insurance? Something has changed big time with this. And we don't talk about it because we don't understand it. But I think it's just more evidence of how the labor market is not what you thought it was. It is not the 2019 labor market anymore. There should have been a big spike of unemployment insurance whenever there's a massive strike, let alone 2 strikes with Hollywood, let alone 3 strikes with Kaiser Permanente. But we're not seeing any of that. And it should be taken away with, you think you understand the labor market? You really don't. We really have to start all over and say, how does this labor market behave beginning with 2021?
Yeah, and if I'm not mistaken, the US has sort of changed how they measured GDP, but that wouldn't take into account all the other indicators that you're sort of recommending. So I guess from your perspective, what are the key economic indicators that you've watched that have maybe changed over these past few years because they're maybe a bit more accurate, or that they're sort of tracking more in line with the new normal? Has that happened at all?
Yeah, I think the biggest thing that people need to do is pivot from looking at real growth measures to looking at inflation measures. I recently saw a word count of the Federal Reserve's Beige Book. Jobs and real growth and all of these retail sales, and all of these metrics of real growth dominate the number of words in there. Lower on the list, but rising, are the words that you would associate with inflation. Costs, the word inflation itself, commodity prices as well, the like. I think the first thing we need to do is we need to say, at a minimum, CPI, the inputs to CPI, things that affect inflation, like container pricing, container shipping pricing, and the like, they are at least collectively as important as the real growth numbers. And those would be retail sales, payrolls, and the like. People scoff. No. That stuff's way more important. No, it is the inflation numbers that is more important. And we need to be focused on those inflation numbers. Frictions are showing up in the inflation numbers. Goods prices look like they're bottoming. They might be starting back up again. Container shipping prices, they're nowhere near where they were in 21, but they have bottomed and they're starting to start back up. Oil tanker shipping rates are soaring through the roof because of the perception of how dangerous it is to be an oil tanker in the Persian Gulf right now. So all of these metrics of inflation are what we should be focused on, and they're starting to turn north a little bit. The metrics of real growth, they're strong now, and everybody's saying, don't worry, they're going to slow down. I understand that. And you might be 100% right. They're going to slow down. And what's going to happen? Interest rates are going to go up. Why? Because the inflation numbers matter as much, if not more. But what you're assuming is these inflation numbers are rounding errors over here because they were for 20 years because inflation was always 2%. You could just say, okay, all the inflation numbers, just write down the number 2. There you go. We're done analyzing inflation. Now let's look at everything else. I think you could almost turn that around. I'm not ready to go there, but I could almost make you a case where, all the real growth numbers, whether it's payrolls, whether it's retail, just put down 2 for real growth. Okay, done with all that. Spend all your time now looking at inflation. So I think that shift has to take place, but it's not. And it's not because you didn't have to do that from 2009 to 2020. And the perception is you don't have to do that. Jay Powell told you today 5 times everything's returning to normal. That we're rebalancing. That's the other word he means. That means it's going to go right back to where it was in 2019. That thing that happened in the first quarter, where the entire global economy shut down, restarted, no one went back to the office, that has no lasting value, is what they seem to be implying. Nothing of significance came. It was a story for 2020. It can be forgotten now, is what they're almost arguing. I think it kicked off an entirely new cycle. And this is why people have been struggling to understand the bond market, the stock market, struggling to understand the economy. And they're not willing to embrace that we are in the 4th year of a new cycle. At least when we were in the 4th year of a new cycle after World War II, that was 1949. And there was no doubt we were done with the 1945 period, and we were moving on to becoming a consumer-led economy. But right now, we're not anywhere near that in this cycle.
Okay, that makes sense. Did you see sort of fiscal spending staying in near similar levels to what we're currently seeing, or do you think the bond market could potentially challenge that?
I think the bond market can, and the bond market is challenging that. Now, there's a lot of people going around saying that one of the reasons why interest rates are going up is a technical reason, that the Treasury is issuing a lot more debt. Now, that's true. The Treasury is issuing a lot of debt. I came into this business in 1985. And there, you can kind of back into how old I am. My birthday's on Twitter, actually, if you wanted to look it up. The first thing I was told in the first week I got into this business was the deficit's out of control, and it's going to crowd out all of the other borrowing, and it's going to send interest rates soaring. And so here we are 38 years later, and we're saying the deficit's out of control, and it's going to crowd out all of the other borrowing, and interest rates are going to be soaring. Never mind the fact that after I heard that in 1985, for the next 31 years, we had a gigantic bull market, and that the deficit was out of control during that period, and interest rates continued to fall. What seems to drive the fear of the deficit and the fear of supply is inflation. And is the fear that inflation is returning. And when it does, then deficits matter. And so because inflation is returning, I think that you're starting to see evidence that deficits matter. Now that I've said that, let me tack one other thing. So we have this thing called TIPS break-evens, Treasury Inflation Protected Securities. If you take the 10-year note yield of 5% and you subtract it by the 10-year note tip yield, which is 2.5% roughly, you get a residual of 2.5%. And what that's supposed to mean is that for the next 10 years, inflation will average 2.5%. And people will say, but that residual or inflation break-even rate is not moving higher. And the surveys of inflation are not moving higher. So where is this fear of inflation? And the answer I would give it to is it's in the stock bond relationship. It's in the term premium going up, the stock bond relationship, the correlation there is turning positive. Very good story in yesterday's Wall Street Journal about that. And even in today's Wall Street Journal about the 60-40 portfolio, and they talk about the shifting stock bond relationship as well, that it's becoming more positively correlated. And because of that, I think what's the driver of all that is inflation. And these TIPS break-evens that people look at, they've never been good indicators of inflation. So the TIPS break-evens say inflation expectations are X. What do they ultimately wind up being? Nothing close to what the market says. It's almost a random number generator of what the market price is in and what eventually happens. So yeah, you could tell me that the TIPS break-evens are not pricing in higher inflation expectations. And I would say, go back and look at its track record. It's never right. It's never right. Now, it could be lower, but it's almost never right. So I don't know what that means, that TIPS break-evens aren't widening. It doesn't mean anything to me. But some of the other measures do say that inflation is a problem.
Yeah, makes sense. So you mentioned before how you think a lot of people will be going for the risk-free rate. It's quite high. It could potentially go higher as well in the coming months, years. So I guess from your perspective, what assets do you see are going to be the ones that overperform, and maybe investors are going to be looking at and will be choosing, or what? Yeah, what assets are you going to be looking at?
So look at the flows, and let's start off with what has been the best performing asset since the middle of 21. It's beaten the S&P 500, it's beaten the MSCI World Index, it's beaten the bond market, and it's been 3-month Treasury bills or cash or a money market fund. Why is all the money going into it? Because it's outperforming everything. That's why all the money's going into it. Well, wait a minute, isn't the stock market up 12%? Yes, but if you take out the Magnificent Seven stocks, and you look at the rest of the 493 stocks, and you look at the mid cap index, and you look at the small cap index, and if you take out the 7 stocks out of the world stock market index, all of them are returning for the year 3% or less. Cash has nearly returned you 4% for the year. Cash certainly outperformed everything last year, because last year everything was down, cash was up. So let's start with what is working: cash. And it's giving you 2/3, as I mentioned earlier, of what you should expect from the stock market. And that's why people are going into it. So there's nothing wrong, I think, ultimately with cash. Beyond that, what also seems to be working in my mind is anything that has a play on inflation, energy, industrials, basic materials, that kind of stuff, really seems to be working as well. Investment grade and high yield bonds, they're doing better than the stock market for, like I like to say, a forensic reason. What's that? The stock market's dominated by healthcare, technology. Those are the big weightings, in the stock market. Consumer discretionary. In high yield, the dominant sectors are casino, gaming, energy, casino, gaming, energy, and industrials. So basically, it's all of the big high yield borrowers are the ones that are working because that's where inflation is, where the stock market is all in the growth stuff, where the real growth market's supposed to be, like in tech and consumer discretionary, and the like, where all the Magnificent Sevens are. None of the Magnificent Sevens are in the high yield index because they're not high yield borrowers, even if they have to borrow. So I think that's one place that's working. Where I don't think things are working at all, if I was to turn the question around, is in financials, and especially in banks. Banks, in my mind, well, not even my mind, the numbers show that they've been a disaster. If you go back to 2008, there's 11 sectors in the S&P. What's been the worst performing of all of those 11 sectors? It's been the financials. Among the financials, which industry within the financials has been one of the worst performing? The banks. The banks they're at the same level they were at 15 years ago. They've given you no return for 15 years. Now, why is it that the banks are such a bad deal? I think there's 2 reasons. Reason one is they're too regulated. Let me back this up, say this way. They need to be disrupted. There is fintech and crypto that are kind of biting at the edges of disrupting it, but the banks are so heavily regulated they can't break in. And the banks think, oh, well, this is good. It's a moat for my business. Yeah, but your business sucks. And that's why you can't give anybody any returns on it. The second reason, I think, is that they are finally being disrupted of their own making. So 15 years ago, and I'm holding up my phone, we started pushing everybody to mobile banking apps. 120 million people use a mobile banking app every month. They use it for 2 reasons, basically: to pay bills and to transfer money. Now, for 14 of the last 15 years, transfer money to what? Everything was yielding 0. My bank account was yielding 0. My money market fund was yielding 0. T-bills were yielding 0. So where am I going to transfer my money? So you didn't. But now that the Fed has been raising rates and money market funds are 5.5, people are starting to bank walk, not run. Run is a panic that the bank is going to fail. A walk is, I want to leave the bank because I want to get a better yield. Now, this isn't 1999. If you wanted a better yield, you had to make an appointment at the branch, take some time off of work, go out and fill some forms to open a new brokerage account. And I like to joke, and then be told a week later you filled out the forms wrong, schedule a second meeting to take some time off of work, go correct it, wait another week, then the account's open, then take a week to transfer your money, then you can put your money in a money market fund. No one did that. No one did that. So the banks always thought that they could always have abnormally low deposit rates and get away with it. Today, people just pick up their phone and they can open a brokerage account and transfer their money in 5 minutes. And they know how to do that because that's what they do with mobile banking apps. They pay bills and they transfer money. So the bleed out of deposits just continues. We've had the biggest drawdown in the 50 plus year history of measuring deposits in the banking system, and it isn't stopping. Now, it does not mean that your money is at risk at your bank. Your money is not at risk at your bank because of the bank walk. What it does mean is if you're the owner of a bank stock, the profitability of your bank is at risk because they're losing cheap folks funding, cheap sources of funding. They take your money, my money, they pay you nothing with it. They lend it out at 6% and they keep all the spread for themselves. Well, if I leave and go to a money market fund, they've lost the ability to make margin off of me. So they're shrinking. They could raise those deposit rates to keep me, but by doing that, now they're going to give me 4% and they're going to lend out the money at 6% and keep 2% for themselves. That kills their profitability. So your bank, your money is not at risk at the bank. The profits are, and that's why the stocks of the banks are suffering so mightily. The exception of the rule might be JP Morgan. I'm not big on the banking industry, so I always like to joke that the banking industry is JP Morgan in various levels of suck, because that seems to be what all bank stocks are. It's either JP Morgan seems to be an okay investment, and then after that, everything falls apart. I mean, Citibank is lower now than it was in March when we were afraid that the whole banking system was going to blow up. It's because of the profitability of these banks. So on the other side, I'm really not high on the financials.
No, makes sense. Thanks for running us through that. So, Jim, thanks so much for your time today. I really appreciate it. My last question is, what is one message you'd like people to take away from our conversation?
That this is a new cycle. This is a new cycle. That does not mean worse. We need to understand that we're in a new cycle, and we need to go about figuring out what needs to be changed and restructured for the new post reopening cycle. We're fighting it. And as long as we're fighting it, we're going to see higher interest rates, volatile markets, and we're going to see, difficulties in investing. Once we start to embrace it, then I think things will start to calm down. And along the way, if you see that this is a new cycle and you see where we should be going, there is plenty of opportunity for you and for me to say, we're going to have to go here and I'm going to invest in this, or we're going to have to go there and I'm going to invest in that. Now, to be very honest with you, I'm still struggling to try and myself figure out what the new cycle is. But where I am at is stop thinking it's 2019. Those rules, that cycle is not coming back. So it is a new cycle. It is not worse. Look, remote work. Employees don't think it's worse. Maybe some managers think it's worse. But overall, that does not mean that remote work has made things worse at all. That's one good, employees might even like it. While managers might hate it. So that's not worse, but it's different, and we need to adjust and we need to understand. And no, you shouldn't be opening up restaurants and retailers in central business districts because people aren't going back to the office 5 days a week like they used to. And so that's just one example. It's a new cycle. We need to understand that cycle.
Great message. So thanks again for your time today. I really appreciate it. If anyone wanted to find out more about your work, where would the best places for that be?
So you can follow me on Twitter at Bianco Research. I will say this because there's plenty of, I'm really down on Twitter because of the spam and the bots. If you look for me, look for the blue check mark with 350,000 plus followers. Otherwise, you might be following a spam bot who will try and cheat you out of money. I'm on LinkedIn too, under my name, Jim Bianco. And we have a website. We provide my day job is we provide research to institutional investors. We have several hundred of them that pay us. And our website is biancoresearch.com. There's free trials up there. There's some samples up there, but most of the stuff is behind the paywall as well. So thank you.
Perfect. I'll put that in the description below, but thanks again for your time.
Thank you. Bye-bye.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.